Alright, stock markets. We have other topics related to the stock market. That's on page 245. The first topic is, well, let's write it in big red. It's called leading economic indicator. A leading economic indicator is an indicator that provides information about or indication about the future of the economy. Leading economic indicators, in a lot of research, are about 10 different variables which gives you an indication about the future performance of the economy. Well, stock market is one of those leading economic indicators. A stock market moving up is an indicator that the economy is likely to move up, and a stock market moving down is an indicator that the economy is likely to moving down. A leading indicator, the same as the stock market, is a predictor of economic performance. This is the same as a forecast of economic performance. Therefore, politicians like to manipulate the stock market, make it higher, make it look better, and if they can make the stock market look better, it's the same as making the economy to look better. Remember, in politics, it's not about making things better, it's about making things look better. It's only about appearances. So, the stock market is an easy way to manipulate for politicians and to make the economy appear better. It's kind of like putting a little lipstick and suddenly you look better, right? It's kind of like the same thing. Okay, next one is market efficiency. Here, market refers to stock market, but it could refer just as well to currency markets, it could refer to bond markets, potentially to any other financial markets, not specifically stock market. Efficiency doesn't mean that it's efficient. It means it incorporates information relatively quickly. So efficiency means that information is incorporated into prices quickly. Okay? That's what it means. So market efficiency means that stocks as well as other assets are rarely undervalued. So now we need something to compare. The alternative is overvalued. And then the last one we'll call fair valued or fair value. Fair value is a value that reflects the true economic value of the true economic value of the asset. That's fair value. Fair value sometimes they like to call true value, and is the same in a lot of textbooks. They like to use the word fundamental value. fundamental value, and sometimes they even say economic value. All of these things basically mean that the price is right. So a fair value is when the market price is equal to the fundamental value, is equal to the economic value. Now, overvalued means that the price is greater than fair value or fundamental value. Now, the FV is oftentimes confused, which is coming very soon, with future value. Okay, so in this case it's fundamental value or fair value. And, well, sorry, that's undervalued. Undervalued, sorry, that's a mistake here, is price is less than the future value. And overvalued, the price is more than the fundamental value. Okay? So, if the fair value, let's say, is $1,000, and the price is $300 or $400, the asset is undervalued. If the price is $2,000, the asset is overvalued. So, market efficiency basically means that information is incorporated quickly, and that most of the time price is trades close to fair value or to fundamental value. So, market efficiency refers to the speed with which information is incorporated into the prices. And market efficiency has a number of forms. So, number 1 is called weak form efficiency. In weak form efficiency, you can't just take old prices, historic prices, and predict the future price. In other words, the future price cannot be determined and does not depend on past prices. If the stock went up and up and up and up and up, it doesn't mean that tomorrow it will be up again. And of course, that's one of the dumbest mistakes that people make in all investing, where they say, oh, real estate's been going up and up and up and up and up since 2003 or 4. It's been up for 13 years, and therefore it will be up for another 13. Wrong. Completely. Just because it's gone up for 13 years doesn't mean it's going to go up next year or for the next 3 or for the next 13. You can't tell anything about future prices based on past prices. If you could, this means that most people are very dumb. They don't know what they're doing. Okay? That applies to stocks, applies to currencies, applies equally well to real estate. But somehow common people don't think that about real estate. They don't understand it. But it's genuinely true. Next will be a semi-strong form. 2. Semi-strong form. The semi-strong form applies to stocks. It basically says that you cannot profit from public information. A different way of saying is that public information is already incorporated into the stock. A third way, which is the same way of saying, is that public information gets incorporated into the price of stock immediately as soon as the information becomes public. So you can read all the statements, you can read all the analysis, you can read all the public information, you can search Google for days, weeks, months, or years according to the semi-strong form of market efficiency. You're not going to be able to make a better decision. You're not going to be able to determine, based on public information, if the asset is undervalued so that you can buy and profit for it, or if it's overvalued. Okay? And then 2, 3 is the strong form. And the strong form says that you may have not only public but private information. In other words, you can also have inside information, and you're still not going to profit from it. For example, I come back originally from Bulgaria, back in the old days when we had this huge stock market bubble, and of course we also had a real estate bubble, kind of like similar to what's been going on for the last few years, well, 5, 7 years in Thailand, similar to what's going on in Cambodia, most of Asia. People said, oh, I'm investing in the stock market, making a lot of money. I got information from the company, okay? So they got an inside information. So they believe that because they have an inside information, they can make a better decision. What they don't understand is that maybe there are 100 other people who have the same information. Maybe 1,000, maybe 10,000 people who have the same information, who have acted on the same information, who probably bought on the same information, and that information is not valuable. In other words, what's important to understand that the information is valuable as long as others don't have it. If you have an information that everybody has it, your information is not very valuable to make profits in the financial markets. Okay? Now, if there's a particular disease, you got a flu or you got a cold, and you got information how to cure the cold, this is as valuable to you, to me, as to you, or as to her, or as to anybody else. When you get the cold, you can cure it, okay? That information is generally valuable. But in the financial markets, it is not. If everybody, if a lot of people have the same information, the information has no value to make financial profits through trading or through investing. You somehow have to have a special information. Your information has to be different. It's a general law. Let's try and write it out here. Let's try and write it out. We've got now jump far ahead, about a couple of years into the future. Is law of investing is very simple and people generally don't understand. Is you can't profit by doing what everyone else is doing. If you invest like everybody else, you can't profit. If you buy real estate like everyone else is buying real estate, you cannot profit from it. Remember, in finance, to make a profit, somebody on the other end's got to make a loss. If everyone's profiting, who is taking the loss? There's got to be a loser for every winner, okay? Now, it is true that the economy grows, and if the economy grows, let's say at 5%, it's possible that the stock market can grow at 5%. It's possible that bonds will grow at 5%. Businesses will grow at 5%. Real estate can grow at 5%, okay? So everything can grow at the growth of the economy. But you can't expect to grow more than that. If you grow more than that, on the other end, somehow has got to be a loser. So it's impossible, all of you to invest in real estate and all of you to be winners. Well, who's going to be the loser on the other end? Now, that's one basic law of investing, okay? You can't profit by doing what everyone else is doing. Therefore, the only way to profit is investing is to do something that few other people are doing. This is known as contrarian investing. Contrarian investing is a strategy where you do the exact opposite of what everyone else is doing. If everyone else is buying Apple stock, contrarians sell Apple stock. They got a better chance of making a profit, okay? So basically, if everyone's selling or not investing in gold, you buy gold. So one of the better ways to understand and to invest profitably in stock markets or anything else is finding out what people are investing in, and you avoid those things. The second step is you ask, when you have an investment idea, if others are investing. If you can't find anybody else who's investing in the same thing, maybe it's a very good investment, okay? If investment is good if they don't talk about it in the newspaper, if it's not on TV, if it's not on news. If you're just doing what everyone else is doing, at best you'll do just like the economy, okay? And no better, okay? So that's the base of contrarian investing. And there is some idea to that. The second basic consequence is that a small percent of investors are winners. So most investors lose. Most investors lose. You'll have to watch the video because you miss some very good stuff. Okay? And only a small percent, few investors win. That's a basic consequence. So usually 5% of investors make good profits and 95% lose. Those that make money make a lot of money in the stock market, and most people lose a lot of money. Of course, for a while they win until they eventually lose. All right, let's see what else we got. The third topic is regulation. Stock market in the United States is regulated by Securities and Exchange Commission. I will not spend or waste any time on how the stock markets are regulated because they are regulated differently in Japan than China, than Thailand, than Bulgaria, than Britain, than US. Every single country has its own regulatory structure. There is no point to waste any time in class to discuss regulation because you don't know which is the relevant regulation for you. Maybe it's Cambodia's regulatory framework, maybe it's Thailand's, maybe it's the US. So wherever you operate, in which country you operate, you will need to learn that particular regulatory framework, okay? Let's see what else is out there. Well, the last topic is international stock markets. Well, the first trend over the last 20 years is that stock markets have become globalized. This means they become more and more international. More people, let's say, from Canada are investing in the US, more US investors are investing in Canada, more Europeans are investing in the US, more American funds and banks and people are investing in European stocks. So overall, stock markets have globalized. The second major trend is stock markets have become integrated. Integrated means American stocks are now traded in Europe. You got a lot of European and Japanese stocks trading in the United States. There are special securities. So that's the second part of integration. And there's another part of integration is that stock markets in one country significantly affect stock markets in another country. So when the stock market in Japan crashes, it usually affects the Chinese stock markets. Well, the stock markets open first in New Zealand. That's, based on the geography. The most eastern country in the world is New Zealand. So New Zealand markets open first, then Australian markets open, then the Japanese markets open, and then the rest of Asia opens. So when let's say the Japanese stock market crashes, usually the next will be the Chinese, and then as stock markets open around the world, they crash one after another. Usually you need a major government intervention to stop stock markets from crashing once they start crashing somewhere. Okay? It could be that there's something horrible happening in Europe, and European stock markets crash, and then the American, the US stock market is set up for a crash too. So integrated means that performance in one stock market highly affects performance in another stock market. The way we can probably test this statistically is to get the returns on, let's say, one stock market, European stock market, and American stock market, and run a simple correlation. That could be a basic assignment in business analytics. Get returns for the last 200 days or 2 years, okay, for the European markets. Get on a date-by-date return, exactly the same returns for the US markets, and then check for correlation. If markets are integrated, you'll have a good, relatively high positive correlation. If the markets are not integrated, the correlation will be close to 0, okay? And you can run the same correlation between Japanese market and Chinese market, between Chinese market and European market, between European markets and US markets, and that's how you determine the degree of integration. Let's see. Another major trend is basically, well, let's write it out first differently, is the general decline of US financial dominoes. This includes the decline of the United States affecting stock markets and currency markets and bond markets and the rest of the economy. So the decline of the US is, and one more, let's do one more. Decline of the US, and the second major decline for the last 20 years is that of Japan. So Japan is going down, 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 down for 25 years and still going down. The Japanese government is proving to be one of the worst governments in the world. It has created the worst depression in Japan that's been lasting now the longest for 26 years. And everything the Japanese government is doing fundamentally wrong. And it only dooms the Japanese economy to a major failure down the road. So, who's on the other end? On the other end is the rise of Europe and European markets due to European integration and the introduction in the euro. So European markets are becoming more influential and more integrated due to the introduction of the euro currencies and all European countries using the same currency, which facilitates a lot of things. The next one is the rise of China. Now, China has a lot of bubbles, real estate bubble and bond bubble and stock bubble and all sorts of other bubbles. And China is also due for a major crash, but economically, China now is the dominant economy in the world. They produce more cars, they produce more motorcycles, more watches, more shirts, more of everything than either Europe or the United States. The Chinese have major savings, so they can use these savings for sometimes productive purposes. Now they use them mostly for speculative purposes. Chinese love to gamble. So they gamble in the stock market. Now the best favorite way to gamble for the Chinese is in commodities, okay? They gamble and stuff. But either way, rise of Europe, rise of China, and rise of some parts of Asia. Big one will be Hong Kong. Next one will be Singapore. Next one will be South Korea. And some of the other, these are known as the Asian tigers, okay. We add in Japan, now on decline, okay. And we can add a little bit, but it's a tiny little country, a lot smaller than Phnom Penh is Macau, okay. And then you have the Asia, these are the Asian tigers, then you have the Asian cubs. The cubs will be Indonesia, Malaysia, Thailand, okay. Vietnam will be in that category. Okay, so the general rise of Asia, the big decline in the US, and of course there is a major decline in Europe, economic, social, political, military. Europe in general is going down. It's the integration of the currency that gives a little bit of strength to Europe. Let's see what else I got in here. Okay, yeah, last piece which I wanted to discuss is that of, well, why invest in international stock markets? It's basically called international diversification. Diversification is the increase in the number of assets that you invest and reduction of risk as a result of increasing number of assets. Well, there is a general belief where statistics and practice generally shows that international diversification works. It works in the sense that if you invest only in the US, you'll get a certain diversification. But if you invest in US and UK, you can improve a little bit your diversification. If you invest in the US and Europe, you'll improve a little bit more of your diversification. If you invest in the US, Europe and Asia, you'll get even further diversification. In other words, the more globally you invest in stocks, the better your overall diversification is. Now, diversification effect, if you have to measure, let's say this is the degree of diversification if you're only in the US, and if you add Canada, you're going to get a little bit, if you get Europe a little bit, if you get Asia a little bit, the improvement will not be significant. But you're still going to get some diversification. And now the last piece to understand, it's a little trickier, is the following. Diversification works when markets are not integrated, when markets are not correlated. So there is a conflict between integration of global markets and global diversification. The more integrated the markets are, the less you benefit from diversification. So, if markets are highly integrated, means that what happens in Japan, similar things happen in China, Europe, and the US, then there will be little diversification benefit. So, the overall global trend is for more integration over the last 20, 30 years, and the result, therefore, is towards less overall international diversification. Let's see if I got anything else. Well, that's it. Can't